I'm asking you a question on the stock markets. You think this is a bubble right now? Because you had the Sensex moving up by about 25% in this year when manufacturing, when factories are being shut, there have been layoffs and all these things. Can you recall a situation ever where you have slowing growth and the Sensex is up by 25%? And I think the Indian now the price to earnings per share ratios are something like 25, which I'm told is one of the highest in the world. So is this sustainable? Is it? I mean, is this some kind of a bubble? I mean, do you think the equity market is a bubble like what maybe real estate was about, say, 2 years ago?
What I would say is, India is not alone. You've actually seen stock markets around the world grow 20-25% in 2017. But the difference, as you rightly pointed out, is these are in countries where growth is accelerating, including emerging markets. In India's case, you've got this kind of stock market increase when growth is slowing. You're right in the following sense that the disconnect between economic fundamentals and asset prices has never been as large in recent memory as it is now. And so from that perspective, that's disconcerting and worrying. The only thing I'll say in defense is, what is the genesis of this? If this was all foreign capital that was coming in, I would say, there'll be multiple triggers and the capital would leave. But you've had this big run-up in equity prices, despite the fact that, as you pointed out, only $6 billion of equity flows have come in all of 2017. In 3 of the last 4 months, there have been outflows. What's changed is that there's been a reorientation of domestic household savings in India from physical assets to financial savings. Now, this predated demonetization. Part of it, I think, is because the real estate sector was in a slump. Part of it is because gold fell out of fashion. So people had begun to reorient their assets from physical assets into financial savings, number one. Number two, I think, as customer education for things like SIPs, SIPs, systematic investment plans grew, more people began to do that. So there was a wall of money already coming in to financial markets. And you can see this by looking at mutual fund assets under management were 30% higher than the previous year, even before demonetization. Then you get demonetization, where all this money comes into the banking system and it has to go somewhere. And so assets under management go up another 30% of a higher base. So one can say the glass half full is, well, this has sounder, less volatile underpinnings. But I am in your camp. I think that ultimately, to justify these multiples, earnings have to pick up. The hope was earnings will pick up in the next couple of quarters, and this is where the elephant in the room is oil. Because if oil prices were to remain at these levels, that's a 15-20% increase in the last year. That's going to hurt profit margins in the corporate sector. You saw that the last time around as well. So if profit margins get squeezed and earnings come under pressure, it will be hard to sustain these valuations.
Or is this divergence between whatever, I mean, like in the US they say, between Wall Street and Main Street. So here also between Dalal Street and whatever, Chandni Chowk, the gap. Is it the fact that when I am investing in Sensex stocks, I am investing in the universe of listed stocks of companies who have not been hit by demonetization and GST and these kind of things. Whereas much of the economy is run on basically unorganized players, and they have been affected. So could it be just that the investors are very rational? They are very clear that formal companies, the big companies, stand to gain because of these kind of things, and we are putting money in big companies. So to that extent, this may not be a bubble, right? I mean, doesn't this say that ultimately the big players, they will do well, the small the SMEs and others will be weeded out? Could that also be a reason?
It's possible. I think what you're seeing is what people in the equity market call it re-rating. Earnings don't pick up, but you keep increasing your kind of price earnings ratio because you're essentially pricing in good things in the future. What have they priced in? The fact that we have a GST. where the organized sector, the formal sector will benefit. The fact that now you had a PSU bank recapitalization, so the hope is that public sector banks will start lending again, right? The fact that you've got other reforms happening. So some of it is a re-rating, I agree, and I don't think the stock market is representative of the economy in large, which is much more informal. But that said, ultimately, when asset prices and economic fundamentals diverge so much, eventually they must correct. And when that happens, it's economic fundamentals don't correct in a hurry, it's asset prices, so we need to be wary here.
So you think we need to be wary at this moment when it comes to... At
these valuations, given the prognosis for where growth and earnings are headed, given where oil is headed, I would be very cautious.